ACCA, developing professional accountants.
We now wish to look at something called standard costing. Now, standard costing, if you wish, is just a valuation technique, a means of valuing units of production, much as we may use FIFO or LIFO or things like that. The fundamental difference with a standard cost is this. We establish some sort of expected cost for each component of our product and the product itself. And the idea is that this expected cost is used for a whole year. Now, standard costing is very closely linked to budgeting. The way I like to think of it is this. When we talk about budgets, we're looking at aggregates and totals, whereas when we're looking at standard costs, we're looking at per unit information. But standards will be a key building block for any budget. So, how does it work? Well, we could say a standard is a benchmark measurement of resource usage. What we're saying is that if we're producing a product, we will have to identify what we expect to use of each individual component that goes into the product and the cost of each of those components. Likewise with labour usage and likewise with any overhead element as well. It is based on using a predetermined cost and, if you wish, revenue per unit. So what we're saying is that the standard cost that we're using for, say, this year was prepared sometime last year as part of the budgeting process. A key use for standard costing is to perform variance analysis. And variance analysis is a form of budgetary control. What we're doing is comparing the actual result to the standard. Remember, standard and budget are somewhat synonymous with each other, in order to establish any differences. And very importantly, it may use either absorption or marginal costing as the basis for the valuation. And we will talk about that later on. Now let's look at types of standard. There are three types of standard that we may discuss. The ideal standard, the attainable standard, and the basic standard. Let's start with the ideal standard. The ideal standard assumes perfection, 100% efficiency, no losses, no idle time. Because of that, it is a very useful long-term organisational goal. You see, the thing is, we are unlikely to achieve perfection. But if we strive towards achieving our ideal standard, maybe we get that much closer to it, and therefore have slightly less losses, slightly less idle time, and so on. You cannot use the ideal standard for variance analysis and budgetary control. The reason being is this. Managers will not be able to achieve perfection. Therefore, they will continuously fall short. If you fall short, it is likely to be demotivational and people give up trying. Now let's look at the attainable standard. The attainable standard is a tough but realistic standard. Tough, i.e., people have to work to achieve it, but attainable, they have every expectation that if they do work hard, they will achieve it. Because of its attainability, an attainable standard is used for budgetary control. The idea is that it is a motivator to get people to work hard, but because it's realistic, we can reasonably expect people to achieve it. Finally, we have the basic standard. Now, the whole point behind the basic standard is that it's a standard that never changes. Now, why would we want a standard that never changes? Well, in simple terms, all we want is a standard that we can benchmark change over time. So if we know what the standard was 10, 15 or 20 years ago, we can see how we have performed in relation to that standard. Can we use it for budgetary control purposes? Well, the answer is no, because of course, if it was set 10, 15, 20 years ago, it will be out of date. So how do we calculate our standard cost? Well, what I want to point out is this. There is a clear distinction between what happens with the variable costs and what happens with the fixed cost. The variable cost, I like to think of, is that we build up the variable cost. So if we're looking at, say, materials, we need to know the usage of the material, how many kilos go into each component, and the price, the cost per kilo. Likewise with labour, another variable cost, how many hours are required per unit of production, and the rate per hour. And variable overhead, some sort of variable overhead absorption rate based on hours, and again, the rate. So, we build up the variable cost bit by bit in order to get the standard cost per unit. If we're looking at fixed costs, you know, our fixed overhead, what we're going to have to do is work the other way around. Because if you remember, fixed costs are a constant in total terms. So we will start with some budgeted fixed cost. And in order to get the unit cost, we're going to have to divide the budgeted fixed cost by the budgeted units. Okay? So if you wish, we break the total fixed costs down. Build up the variable cost, break down the fixed costs, and then we have our standard cost per unit. So what do we use standard costs for? Well, we've already discussed a couple of uses, but let's just go through all of the potential uses. First of all, preparation of budgets. I said to you that they are synonymous with each other in many ways. Budgets and standards are essentially the same thing. If you want to make a distinction, budgets are in total terms, standards are per unit. A key use would be stock valuation. You may have learnt things like weighted average method and FIFO and LIFO, but the problem with methodologies like that is that you have to continuously update them every time you have a new delivery of goods. The great thing about standard costs is that we value whatever components or products that we have at the same amount throughout the year, which does make life a lot easier. The big one is budgetary control and variance analysis. Remember, we talked in budgetary control about the idea of comparing actual to budget. Well, all we're going to do here is compare actual to standard. And the fundamental thing about variance analysis is this, is it provides the detail to our budgetary control. Because the most important thing to remember about variance analysis is that we're breaking up the data into as smaller components as possible. The idea being that the more detail that we have, the better understanding we will gain as to why any difference has arisen. You could say that we may use it for decision-making, pricing, and performance monitoring and evaluation. Most definitely. When we set our standards, there will be problems, however. The biggest problem comes from this simple issue. When was the standard set? Well, I said to you that the standard was set sometime in the past as part of the budgeting process. So when does the budgeting process occur during the year? Well, many years ago when I used to prepare budgets, this is precisely how it used to work. We would start preparing our budget somewhere around April, May, and we would prepare the budget from April and May through June, July, August, September, October. We'd try and complete the budget in October relating to the following year. Now, when would we need the standards as part of that budget? Well, remember, I said to you before, standards are a fundamental building block of budgets. So the issue is that we're probably going to need the standards somewhere around April, May, June. So hold on a moment. We're preparing standards in April, May, June of one year, and then we're going to use those standards in the following year. That's a bit of a problem. That's a bit of a problem because the issue is those standards could easily become out of date. We'll deal with that issue later on more explicitly. In summary, when we look at standard costing, the one thing that I would emphasize more than anything else is the close link between standard costing and budgeting.